Markets are looking weak. We got one great day of breath and then it was back to puke city today, with bonds, stocks, commodities, cryptos all falling, yields rising, and the dollar catching a bid, signaling that what we're seeing is early signs of a flight to cash, also known as liquidation. So is it time we go to cash, and what normally comes next when markets liquidate? That's what we're here to talk about, as well as earnings, yields, rates, the Fed, and of course tomorrow's long-awaited GDP figures. Is the data expected to come in hot, cold, or in line? Join us as we talk about stocks and the financial markets. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. Very similar day to what we had yesterday. We saw the big names outperform the rest of the market, and that really held up the major indices. We saw Microsoft, Apple, Nvidia, Google, Meta, Amazon, Tesla, maybe not Google, they all put out a gain despite the price action in the rest of the sector. Look at stuff like discretionary. Most of the sector was red. Look at stuff like software, semiconductors. Most of these were red, while the bigger names in each sector were green. Amazon was up nearly 4% on the news. It's releasing a division very similar to Temu. Tesla was up 4.82% on the back of some of the news we saw with Rivian, and integrated shipping was up quite a bit on the back of FedEx earnings yesterday, and FedEx itself was up 15.52%. But most other sectors didn't do so well. Outside of big tech, the market was mostly sluggish as investors await inflation data on Friday and GDP tomorrow. Along with awaiting data, investors are actually grappling with a couple of the indicators they're seeing here in the market. Stuff like market breadth. These big names are clearly outperforming the broader market, as well as the presidential election debate. These things can all cause volatility. The market is trying to decide, is this something deeper, or are we actually going to get the rotation trade from these bigger names into the rest of the market once we get the data, the election certainty, and things like that? But if we actually dive into the sector analysis, you can see the best performing sector was discretionary here on the back of Tesla and Amazon. And the second best performing sector, up 1.33%, was XME metals and mining, followed by regional banks, and then home construction. Very, very weird price action. They all outperformed the SPY, and every other sector underperformed the SPY. And when you have stuff like XLC, XLK, SMH underperforming the S&P 500, closing on a red day, you're going to see major underperformance here in the S&P 500, but it still actually put out a green day despite the price action you see here. And the worst performing sectors were stuff like energy, financials, utility, so mostly like these value and rate sensitive cyclical sectors. Now today really was a weird day of trade. The S&P 500 was up 0.16%, the Nasdaq up 0.25%, but yields actually rose. The 10-year yield was up 1.91%. Bonds were sold off. The AGG and TLT were down 1.45% and 1.43% respectively, and commodities, gold was down 0.9% for the day, and silver down 0.46%, breaking the $29 level. Crude was pretty much flat. But then when you actually look at the broad market, the RSP, the equal weight S&P 500 was actually down 0.38%. So you had equities falling, bonds falling, commodities falling, yields rising. What was the actual outlier here today? It was the dollar. The dollar rose 0.41%. This pretty much tells us that what we saw today was partially just a liquidation. We saw a rotation into the bigger names, Nasdaq 100, S&P 500, away from the broader market, small caps, mid caps, which were all down 0.2, 0.3, 0.3%. And we pretty much went into the bigger names, Nvidia, Apple, Microsoft, as well as the dollar. So we literally saw a liquidation. We saw a flight to cash and a flight to quality in the bigger names, awaiting some of the uncertainty with the presidential election debate coming up, the GDP data tomorrow, PCE data on Friday, and there's also some geopolitical uncertainty that's happening in the Middle East right now, as well as a couple of other data points. So the market really feeling uncertain right now. So despite all of the headline uncertainty, if you actually dive under the hood in the S&P 500, there was a lot to love in the price action. Now, you do have to take it into consideration that number one, the advanced decline line is actually moving down in the S&P 500, and while it's not following the market cap weighted S&P 500, it is tracking the RSP relatively well when you look at that. A couple of things, again, like I said, despite the headline uncertainty, there was quite a lot of bullish momentum under the hood. Look at the RSP, right? This is today's candle. Yes, a lot of the big move, we were down 0.3%, but a lot of the big move was actually predicated on a gap down. Let's exclude the gap down. We pretty much finished flat for the day. In fact, you hop on the 5-minute chart, have a look at the price action, right? So you could see, let's close this. This is the price action right here. So we have our gap down, then we have this massive candle here, this wick, and then we actually couldn't break and hold this wick zone right here. What does this tell us? This tells us that this is where the algos were buying, and you could see algos actually front ran this level at this point right here, and then we moved higher, actually breaking the day's highs on a wick and closing pretty much near the intraday price action, excluding the gap. So that's very, very interesting when you dive into it. So, you know, you look at the daily chart, you look at this in aggregate, you say red day looking grim, you pull up the advanced decline line looking grim, but then you look at the S&P 500 looking green, and you could say, yeah, okay, I get it. It's probably these bigger names that's holding up everything. But you have to understand that even in the RSP, if we pull up the RSP, we did see quite a lot of buying, as I just showed you guys previously. Now that is the bullish momentum under the hood, but that's about it. That's pretty much all the bullish momentum we saw. Other than that, what we did see was a lot of bearish momentum. And at the end of the day, you do have to understand that, yeah, we actually did gap down, and there's a reason we did gap down. There's a reason why we actually saw the flight to quality that we did with the Nasdaq 100 and the S&P 500 outperforming the broader market. And guys, until we actually get the call gamma resistance moved up to 5600 and we exit the window of weakness, which will only be next week, continue to see down momentum, if anything, side momentum. Maybe not necessarily the S&P 500. There's a lot of bullish momentum with Nvidia, Amazon, Apple right now, as well as Google, but we will see down to sideways momentum in some of these other names. I'm looking at stuff like RSP, the IWM, mid cap, small caps. So where does that leave us with price action for the rest of the week? Well, I've been saying it all week and I'll continue to say it. We don't have any clear path in the S&P 500. Normally we look to the call gamma resistance, look for strategic buy zones, buy those dips, head up to the core resistance. The core resistance is at 5,500. We're at the 5,500 level, and that's why we're sort of trading sideways. And until we actually get further direction on the core gamma resistance, either it stays where it is or it moves up, then we do go higher. If it does stay at 5,500, even if we exit the window of weakness, do expect sideways momentum. But for right now, you just want to sit through the volatility that's coming. There's a lot of events happening here in the pre-market. In the after hours, we could see gold is catching a bit, commodities catching a bit, because there's quite a lot of Middle East tensions at the moment right now. So you just want to sit through the volatility, guys, especially with the big data points we have coming up tomorrow and the day after with PCE and GDP. So let's talk about earnings. So we're going to dive into Paychex and Micron, but I also did a brief look at a couple of other names. General Mills were down. I think earnings were just a little bit atrocious. BlackBerry and Concentrix were pretty much flat on the day. Levi's was down 13%. Very, very brutal action in that name. Jefferies too, down 6%, Aero Environment down 4%, I believe. So very mixed day of earnings, but let's dive into Paychex as well as Micron. Now, Paychex were down 6.11% here during today's trade, and that's because EPS came in line, and that had to do with a bunch of factors. Now, this was technically a double beat. EPS came in line. Some people were expecting $1.10. You could say it was a beat, and then sales of 1.3 billion versus 1.29 billion against the street's expectations. The problem with Paychex right here was actually just the guidance. EPS actually was a pretty good guide. The street was expecting 4.97. They guided for 4.96 to $5.05 in EPS. The revenue guide was just a bit light. The street were expecting 5.5 billion. Sales were 5.49 to 5.557 billion. So that pretty much means a lot of the EPS is going to come not from the revenue side, but from expense management. And that's actually what we saw in this earnings year. So we're going to see continued value accretion through expense management and not so much revenue growth. But you know what? The overall earnings for Paychex was very, very good. Their operating margin expanded, their gross margin expanded. A lot of this expense management started to yield tangible effects. I do believe at the start of earnings season, this EPS was actually going to be 107 is what management guided for initially. So you actually see EPS come in above that target range is really, really good. I actually thought it was really great earnings, and I do think that, you know, if you do like this name, this is a great dip buying opportunity, because it's probably going to find a floor and then continue its rally back to, you know, these levels here pre the release into next quarter's earnings. Now let's actually talk about Micron. Now this was a double beat and a raise. Very weird price action here, down 6.82%. So, you know, we beat on EPS 62 cents against 53, on sales of 6.81 billion against 6.67 billion. That was the street street's expectations. Now, this is very, very weird. Look at this EPS guide. The street was expecting $1.02. Management guided for $1 to $1.16. I mean, on the upper end of that guidance, you're beating the guide by about 16%. That would be a tangible increase to earnings and a tangible beat if this figure is achieved. And if you look somewhere in the middle, let's call it 8 cents, $1.08, you know, that's you're handily beating the street's expectations. But I think it was actually the sales side that let the stock down here in the after hours. The street were expecting, you know, 7.6 billion. Management came in with 7.4 to 7.8. So smack bang in the middle of the guide. I think the street were expecting something a little bit more, maybe more like 7.5 to 7.8. But the stock got hammered down in the after hours. But I do think this is just a dip buying opportunity. I think that management partially did sandbag guidance. Overall, the earnings were very, very good from a sales and margin perspective. But these aren't necessarily earnings reports. These should really be called guidance reports. And you know how the saying goes, the market can't stay irrational longer than you can stay solvent. Okay, looking at Gamma, guys, not much to say. Everything is pretty much the exact same, except the put support has actually moved down to the 5300 area. Gamma flip still at 54.45. The put support still at 5500. You still want to be buying dips around this 54.50 area, looking for the 55.50, and eventually when we do move up the tape, the 5600 strike. So not much has changed from yesterday. If you want a full explanation on the Gamma chart, go check out yesterday's video. So in yesterday's video, we tackled S&P 500 earnings. For this quarter, we're looking like 8% earnings growth, closer to 8.1. And for the next quarter, we're looking at about 9% in earnings growth for the S&P 500. We can also see that 2024 revisions are tracking well above the typical path of bottom-up consensus EPS revisions. This right here is the median. On average, we see negative 8% a year leading up to those earnings. And in 2023, it was probably closer to 13%. But correlation is not exactly causation, and when you dive into the details, you can actually see that earnings up revisions doesn't necessarily mean relative performance improves. Now this right here is year-to-date relative performance of said sector versus the year-to-date earnings growth revisions. So let's say the revisions got revised up 8% and the relative performance was 6%, you would say that the relative performance is underperforming the earnings revisions and vice versa. Now you can see here that technology and communication services have seen upward earnings revisions, and the relative performance is actually equal to or greater than those earnings revisions. On the flip side, we have these stocks right here: healthcare, industrials, energy, materials, staples. They've seen earnings downward revisions and their relative performance has suffered as a result. And then on the flip side of the candle, we have financials, utilities, discretionary, and real estate. They've seen earnings up revisions too, but their relative performance has suffered as a result. Now, why this discrepancy when earnings revisions are to the upside but relative performance to the downside? Well, it has to do with macroeconomic factors. Technology and comm services aren't necessarily tied to the macro economy or interest rates. These companies have fairly healthy balance sheets, business models that can operate in almost every environment. Bull markets, bear markets, boom, busts. We saw that with COVID. We saw that in 2021. We saw that in 2022. And we're seeing that now in 2024, whereas financials and real estate are largely tied to interest rates, utilities is tied to commodities, and discretionary, well, is tied to the consumer. Communication services and technology don't necessarily have these constraints. And then these are the ruts of the litter. But where there are divergences, there are opportunities. And for those of you that have maybe missed out on the rally, I see quite a number of you in my comments. You can actually look at stuff like financials, utilities, discretionary, and real estate as potential turnaround plays when relative performance catches up to earnings. One thing that this chart does show us though is that despite earnings revisions, relative performance has definitely been skewed to communications and technology. We can definitely see that in these sector charts. This right here is the S&P 500 and the relative performance against each sector. So long story short, if this chart is going up, it means the sector is outperforming the S&P 500. If it's going down, the S&P 500 is outperforming said sector. And the only two sectors that are outperforming the S&P 500 is this right here, XLC, the communication services sector, and XLK, the technology sector. You can see these are beating the S&P 500 on a year-to-date performance. Every other sector is actually underperforming the S&P 500, and it's far better just to hold the S&P 500. And that's why it's so difficult to beat the S&P 500, because so few stocks do, but those few stocks make up a huge margin of the S&P 500's performance. But let's actually talk about market tops, market breadth, and earnings. Now, this is a note here from Ned Davis Research, and they say the evidence remains supportive for stocks with earnings showing a broadening recovery into their second year despite stickier than expected inflation. However, it is crucial to remain vigilant for signs of market tops, often indicated by early warning signs found in stock price movements. Market peaks usually follow a process, starting with a cycle high followed by pullbacks and subsequent rallies that may lack broad participation, potentially leading to fewer stocks maintaining upward trends. While most divergences tend to resolve bullishly, recent record highs in major indices like the S&P 500 and the Nasdaq have not been confirmed by several breadth indicators, underscoring the importance of evaluating these divergences. Perhaps the most glaring divergence stems from the percentage of stocks in the NDR multi-cap universe above their 50-day moving average. While some divergences have persisted throughout the year, many have just surfaced, suggesting that if the market is approaching a peak, it's in its early stages. Insufficient evidence warrants altering an overweight recommendation to US stocks currently. So despite everything we're seeing, Ned Davis Research said that if we are approaching a market top, we are in the early stage. And if you actually look at the chart on the screen right now, you could see that even in 2021, that when these divergences did start to rear their head, it was many months later that we actually saw a market top, and the S&P 500 did rally 20-30% before the market top actually resolved. So you still want to hold equities, you still want to remain long, and what you actually want to look for is more divergences, downward earnings revisions, and maybe some weakening in the macro environment, which we're going to talk about later on in the video, as a determination for when the market might actually top. But as it is right now, it is still early days and the evidence still remains supportive for stocks. Furthermore, adding on to that, the S&P 500 typically peaks when quality and momentum are outperforming versus history and when valuations are elevated. Factor signal for market peaks based on quality, momentum, and valuation. Signal is triggered when above the zero line right here. And you can see that there's still some gas left in the tank. We're not quite above the zero line, but normally when we do get there, that is when we actually peak. The problem is, just because we get to the zero line does not necessarily mean we peak. We do go a couple of months to the upside before we actually see a massive pullback in stock market. And at the same time, a lack of market breadth and broad participation is not necessarily a bad thing. You can see here that typically speaking, 4 stocks account for about 50% of the gain in the Nasdaq 100 in years when we've had 10 to 25% gain in the NDX 100 index. You can see, look at years like 1987, the Nasdaq gained 10.5%, stocks accounting for 50% of the return. 2, more recently, 2014, 17.94% return, stocks accounting for 50% of the return. 4, and again here in 2023. So just understand that correlation is not necessarily causation, and the market can continue rallying on a few number of stocks. That's not completely out of the norm. Guys, as we get into some of the key macro releases later on in this week, I want to talk about where we stand with regards to rate cut probabilities. Now, this is the actual Fed funds rate right now, 525 to 550 basis points. And it does look like the overall sentiment is that we are probably going to keep the Fed funds at this rate here in the July meeting. 89% probability of keeping the Fed funds where it is, 10% probability of actually a 25 basis point cut. But then we actually look at the September meeting and we can actually see market probabilities of a 25 basis point rate cut sitting right now at 70.33% and keeping it the same at about 30%. So definitely skewed towards a cut. The market is thinking a cut in September, and then we can see in the November FOMC 96% of a 25 basis point cut, 3% of a 50 basis point cut, and it pretty much looks like all but assured that by the end of this year we will have a 25 basis point rate cut. Now this can all change in a dime, but as it is right now, the probabilities are stacked of a 25 to as much as a 50 basis point rate cut before the end of 2024. Guys, let's talk about the economy. Now, the Fed's GDP now sitting at 3%. As you can see right here, very interesting. The blue chip consensus sitting at 2%. I can guarantee you the truth is somewhere in the middle. But let's actually talk about the consumer, guys. Dive into household balance sheets. Now, they remain stronger than they did in 2019 across the distribution curve. This is from the 25th percentile all the way to the highest net worth income percentile. Now this is as a percentage of disposable income, and you can see in the first quarter 2024, net worth as a share of disposable income is higher in every single category, showing that through all of the stimulus, the individual consumer did actually get richer as a result. Now this is as a percentage of disposable income, which is very telling because disposable income has actually outpaced prices across the wage distribution curve. The average consumer is actually gaining pricing power. You can see this is the median against headline PCE, which is very, very interesting. And this is the 10th, 25th, 75th, 19th, 90th percentile. So across the board, consumers are actually gaining pricing power. But the reason why the average consumer is actually gaining pricing power is simply because small businesses and business as a whole just have to pay more wages. This right here is payroll payments. And payroll payments are over 40% higher than the 2019 average. Payroll payments per small business client now at 100 right here is indexed to what it was in 2019. And you can see across the curve, small businesses simply have to pay more money to individuals. And in some instances like Charlotte and Tampa, they have to pay 20% to 40% higher payrolls than they did just 4 years ago, which is absolutely crazy. And that's why small business optimism in the last 2 to 3 years has pretty much moved sideways. We haven't seen much improvement. And although small business optimism has reached its highest level this year, it still remains well below its pre-pandemic level. So it's really tough out there for small businesses. If you own a small business, leave a comment and let me know if you're optimistic or pessimistic in the economy over the next 12 months based on the business you're in. So tomorrow we get GDP data. The assumption here is 1.5%. That is both its estimate as well as the consensus. I think anything higher would be great. Anything lower can be a bit problematic for equities and for the financial markets. We also get personal consumption quarter over quarter, the seasonally adjusted figure. Both expects 1.8%, the price index at 3%, and then core PCE, the seasonally adjusted figure at 3.6%. So pretty much tomorrow's GDP figures is going to tell us where we sit with regards to PCE, which comes out on Friday. So pretty much for the rest of the week, buckle up guys, because it gets very, very hectic, especially with stuff like durable goods, personal spending, the savings rate, University of Michigan sentiment, purchasing managers index. Is a lot of big data points as well as earnings for the rest of the week. So do be prepared for volatility. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.